What if today, less than 0.01% of the world's population holds more influence over public decisions than hundreds of millions of voters combined? This figure seems absurd, almost provocative, yet it captures a quiet shift in power that happens not through elections or coups, but through carefully interwoven financial, legal, and institutional mechanisms. What we see in the news, congressional debates, presidential elections, partisan conflicts, is only the visible surface. Beneath it lies a much more stable, much more discrete architecture that shapes what governments can do long before a citizen casts a vote. To understand this machinery, we must step away from the news cycle and return to the archives, to the internal memos, legal briefs, technical agreements, and laws written in deliberately dry language. It is in these documents that we see how the ultra-wealthy, individuals, families, funds, conglomerates, do not govern directly, but instead frame the limits within which governments can operate. This is not an abstract issue. It directly impacts the financial stability of the average American. Since 2021, inflation has eroded purchasing power faster than real wages. The cost of housing, health insurance, education, and credit has risen in a context where the Federal Reserve was forced to sharply raise interest rates. For many households, finances are still holding together, but under constant strain. And this strain isn't just the result of visible, bad policy decisions. It's the consequence of structural constraints imposed over decades. Consider a concrete example. When a U.S. government considers stricter regulation of a sector, energy, pharmaceuticals, finance, it immediately hits an invisible wall. Market reactions, the cost of financing debt, potential capital flight, pressure from institutional investors. These reactions are not natural. They are the result of a system built to give capital maximum mobility and the state an asymmetric financial responsibility. The blind spot in this story is found in a document rarely mentioned in public debate, the 1971 Powell Memorandum. Written by Lewis Powell, later a Supreme Court justice, this text was not a law or a political speech. It was a confidential memo to the U.S. Chamber of Commerce. Its conclusion was simple. According to Powell, the business world was ideologically under attack from universities, the media, and regulators. His recommendation was strategic. Invest massively and long-term in intellectual, legal, and political influence. This memo marked a turning point. Starting in the 1970s, America's great fortunes and large corporations no longer just funded electoral campaigns. They funded think tanks, university chairs, specialized law firms, research institutes, and permanent lobbying networks. The goal was not to win an election, but to define the framework within which all future elections would operate. It is in this context that major decisions unfolded: progressive financial deregulation, the weakening of unions, the prioritization of shareholder value, and later, legal rulings like Citizens United in 2010, which institutionalized the idea that money is a form of political free speech. This is not a conspiracy. It is a documented, acknowledged legal strategy. For the average American, this translates into an economy where productivity gains no longer flow proportionally to wages, where savings depend on increasingly concentrated financial markets, and where retirement is exposed to global stock market cycles. Financial stability exists not because the system is fair, but because it is optimized to avoid its own collapse, even if that means gradually transferring risk onto households. It would, however, be intellectually dishonest to claim that everything is perfectly controlled. Economics is not an exact science. The same experts who theorized market efficiency did not see the 2008 crisis coming. Central banks themselves admit their misdiagnosis of transitory inflation. The ultra-wealthy do not steer every decision, and they too suffer systemic shocks. But what sets them apart is asymmetry. They have the time, capital, and structures to influence the rules of the game, even when they are wrong. Governments, on the other hand, manage emergencies. And it is in this gap between long-term strategy and short-term politics that the essence of modern power plays out. This analysis is not a moral judgment, nor financial advice. It is a historical and structural reading of the power dynamics shaping the contemporary economy. What follows will examine how these mechanisms have gone global, how trade and financial agreements have extended this logic beyond U.S. borders, and why this system, despite its flaws, continues to hold. From this point, the story can be read as a sequence of three acts, not separated by sudden ruptures, but by gradual shifts in the balance of economic power. The first act begins after World War II, with American hegemony. In 1945, the U.S. concentrated nearly 50% of global GDP, held the majority of the world's gold reserves, and established the dollar as the anchor of the international monetary system through the Bretton Woods agreements. At that precise moment, the alignment between public and private interests was almost total. Industrial growth, the expansion of the middle class, and the rise of large corporations all moved in the same direction. The state invested heavily. Businesses produced, households consumed. This hegemony rested on a real foundation: factories, wages, infrastructure, cheap energy. But this hegemony contained a structural fragility. It relied on the U.S. ability to finance the world in dollars while maintaining confidence in its own fiscal discipline. When that confidence began to erode in the late 1960s, Vietnam War, social spending, trade deficits, the system cracked. In 1971, the end of dollar-gold convertibility marked a historic shift. The dollar was no longer backed by a tangible asset, but by the credibility of the U.S. government and the depth of its financial markets. This is where the second act begins: the debt lever. Starting in the 1980s, American growth became increasingly dependent on credit: public debt, corporate debt, household debt. The system did not collapse. On the contrary, it accelerated. Financialization turned debt into an asset, then into a financial product, then into a yield instrument. Bond markets became central. Large financial institutions no longer merely channeled savings, they structured the cost of time. For governments, debt became a political tool. It allowed painful trade-offs to be postponed. For private actors with privileged access to capital, it became a lever of domination. The larger the player, the cheaper it could borrow. The cheaper it could borrow, the more it consolidated its position. This mechanism is documented in Federal Reserve and Treasury data. Capital concentration accelerates as long-term interest rates fall. The average citizen is progressively integrated into the system out of necessity. Mortgage debt, student debt, consumer debt. Their purchasing power is artificially sustained by borrowing. As long as rates remain low and asset prices rise, the system appears stable. But this stability is conditional. It requires a constant injection of liquidity. This is the third act, the one we have been living since the 2008 crisis, the era of permanent liquidity. Faced with the collapse of the global financial system, central banks adopted unconventional policies: quantitative easing, near-zero rates, then negative rates in some economies. The Federal Reserve became the lender of last resort, not only for banks, but indirectly for the financial markets themselves. This abundance of liquidity is not neutral. It does not spread evenly through the real economy. It concentrates first where assets already exist: stocks, bonds, real estate, private equity. Holders of these assets see their wealth grow much faster than labor income. This is not a theory. It is observable in the Federal Reserve's data on wealth distribution since 2009. If this trajectory continues, what might the U.S. economy look like in 15 years? Historically, empires do not collapse when they are poor, but when they become too dependent on internal mechanisms for redistributing power. The late Roman Empire lacked not wealth, but fiscal efficiency and social cohesion. The 1929 crisis was not the product of scarcity, but of excessive leverage and extreme concentration of financial capital. In a continuity scenario, the U.S. could maintain a facade of prosperity, deep financial markets, technological innovation, dominant global corporations. But beneath that facade, social mobility could continue to contract, and fiscal policy could become increasingly constrained by debt service. Democratic room for maneuver does not disappear, it shrinks. Geopolitically, this configuration opens opportunities. China, for example, is closely watching this American dependence on capital flows. Beijing does not seek to immediately replace the dollar, but to reduce its strategic exposure. Bilateral agreements in local currencies, development of alternative payment systems, accumulation of real assets. The BRICS, for their part, exploit the cracks in a system where liquidity is abundant but conditional on political alignment. This is not about an imminent overthrow of the world order. It is about a diversification of options. The more the Western financial system rests on confidence in its debt management, the more external actors seek insurance against future instability. The blind spot of this period is often misidentified. It is assumed that the winners are only the visible billionaires or big tech companies. In reality, the most stable flows go to far less publicized institutions. Systemic asset managers, clearinghouses, derivatives market players, and holders of structured sovereign debt. These entities profit not on growth, but on the permanence of the system, whether it is expanding or under stress. It is important to qualify this. None of this involves a secret plan or a coordinated conspiracy. It is the result of strategies by diverging interests playing out over long economic cycles. Each actor optimizes its position within a given legal framework. That framework, in turn, is the product of decades of cumulative decisions. Economic history shows that these cycles are neither eternal nor mechanically destructive. They readjust, sometimes slowly, sometimes brutally. Understanding who benefits in each phase is not an accusation, but an analytical tool for anticipating the system's next transformations. At the end of this analysis, the verdict remains intentionally open. The United States does not give the image of an empire in agony, but of a system in profound transformation. The indicators of power are still there: innovation, market depth, capital attraction. At the same time, fragilities are accumulating, less visible, more structural. Economic history shows that decline and transformation often use the same signals and are only clearly distinguished in hindsight. Money in this dynamic is neither neutral nor moral. It is an extension of human nature. It concentrates greed, of course, but also the instinct for survival and the capacity to innovate. The same financial mechanisms that amplify inequalities also fund technological breakthroughs, infrastructure, and transitions. The problem is not the existence of capital, but how it steers collective choices without always being named. The central question then becomes less economic than philosophical. If money rests on confidence, and if that confidence is maintained by promises of future stability, how far can it be stretched before it wears thin? Do you think confidence is an exhaustible resource, or simply cyclical, like everything else in economics? Because the irony is this: in a world saturated with liquidity, what may be most valuable is no longer money, but the belief that it will continue to have meaning tomorrow.